Okay, this is Timing Strategies client update blog. Again, this is an update for client accounts. If you're not a client and you happen upon this, please feel free to give us a call with any questions. This is not a solicitation to buy, sell any investment securities whatsoever, but we're happy to speak to you if you have any questions. Okay, for Friday, July the 11th, let's take a look at what we got here now. Well, guess what? B2 got hit. Nice. Now, what are we going to do about it? That's the only thing. We were long. We still are long. 45% here. What are we doing, though? Actually, we're long a little less than 45%. Well, actually, we're long more than 40. Yeah, no, we're long 45%, excuse me. Taking all things into consideration. We're basically long 30% on the indices. Wait, 20% on the indices using the Dow, the S&P, and the Dow, the S&P, NASDAQ, Russell, and the mid caps from this point right here. And we are also long another 15% in the precious metals funds. Excuse me. And we are long from there as well in the precious metals funds. Actually, we're long from back here. Excuse me. So effectively, we're long 45%. Now, I want to make the point that we've been looking at this level all darn year at 122.5, which is the low exactly, 122.49 for getting long. And I would have gotten longer today. I would have put in a bigger position on, except the fact that we're in a Friday. There's still a little bit of uncertainty. I have every bit of confidence. I could be wrong. I've been wrong many times. If it wasn't a Friday, if it was any other day of the week, I more than likely would have gotten long up to about 60%. Again, the level of commitment that I had originally had back in the beginning of the year when we mapped out B2 as a 120% commitment, that's not happening yet. We need to see some elasticity. Ultimately, I think this bounce, if we get a bounce starting tomorrow or next week, if we get a bounce, it's going to fail. It's just a matter of how high is it going to go. Well, from today's close, again, we're still looking at 1335 to 1340 on the S&P cash, which basically comes into 133.50 to 134 on the S&P cash. We may get short, or we'll start taking some of that position off. But what does that represent on the way back up? Let's take a quick sneak peek. That's about a 7.5% move. We could get as high as 137.5 and then fail there. But again, we did not overcommit going into the weekend on capital. What I do want to make some points about here is everybody's talking about, oh, is the bottom in? Is the bottom in? Is the bottom in? Just like the same way they're talking about, oh, where is the top in oil? The top in oil. Let's look at the USO as oil. And everybody's been calling for a top, calling for a top. I thought we might have saw a little more price action below that range. We did not get it, but again, I did not make any commitments as far as what to do. Just let it happen before we do anything. I myself think that even if the top is not in oil, if we trade back down into this range somewhere, and if we trade from that range back down and close below the lows of this range down in here at the 107.5 level, then I would say or make the estimation that the top is in for oil. Even if the top is not in for oil, if we chunk around or flop around in this area, I feel very confident that we are at least looking for a short-term bounce in the major indices. And here's the Dow, here's the diamonds. What we need is to get simply a close, which will really set the shorts up for a move to cover. And I don't think there's really that many shorts out there anymore. I think the smart shorts are basically pared down their positions down to nothing because they're looking for the same thing. That's the problem, is that the shorts are covering at their lows and putting them back out. They're not keeping them out, so that they can't really get squeezed. Number two, markets don't go down because of shorts. The stock market does not go down because too many shorts are shorting the market and these evil short sellers. BS. That's just another garbage, Congress, Jim Cramer garbage that is just designed to throw smoke. The reason markets go down is because there's no more buyers. Buyers are not buying. Okay, the market is 95 to 97% buying and maybe 2 to 5% short selling. That's it. The only reason markets stop going down is because there's no more sellers, and number two, because the buying is basically gone off. So what happens is long liquidation basically runs its course. People that have had their profits start selling it. People that are at losses start selling it. But the people that are longs basically put the market in at a bottom, and the people that are long traders only put the markets in at their tops. So my estimation is, looking at the spiders, looking at the Dow, let's just go back to the spiders. Oh, and also the other thing I did is I put in here some volume, so we can take a look at, not necessarily massive volume, but we're getting close to what we saw back in January of this year. We've certainly superseded what we saw back in March on the Dow and the diamonds. Let's look at the spiders. We're very close to the same level there. Again, as well, if not better, back in March on a 3 to 5 day basis. So what I'm looking for, using the S&P, and again, we may get long depending on what kind of price action we get going into Monday. We don't want to buy into a high close, meaning something like that. We don't want to add too much. If we can get the market to go higher without taking out the highs of this level here on a closing basis, but just basically close back above this level, but not too far above the highs of today's high, we may add from that long position to be from 45% long to maybe 60% long. But again, remember, we are also long the GDX, or the gold sector ETF, using the RIDEX mutual funds for the precious metals from back here. We increased our allocation back here. So that is effectively hedging our long position, because again, the gold precious metal sector is being up and the overall market being down, although not as bad as dramatically people might try to cast it as in the media during the intraday. Yeah, intraday is a lot worse than the close, but that tells me something, that the market is not closing really that much lower than it has on a lowest closing basis for the last 1, 2, 3, 4 days. So that close has really been within about 1% of the last week. So again, what we're going to do, we may add, we may not, depending on how the market trades on Monday, Tuesday. Worst case scenario is if we get a move that takes us down even lower, one more wash. The sentiment's bad enough. I'm not calling a bottom here. If any kind of bounce that we get is only going to be temporary, and it shouldn't, go too much higher than about 133.50. I doubt greatly that we'll see it going any higher than 137.50. And at that point, if we even get that lucky, we'll put our shorts back out there from then. But for now, I feel that we've put in a short-term temporary low that should get us about at least a 5% move back up into this range, somewhere close to that 133 level. Feel free to give us a call. And again, this is not a recommendation for anybody to buy or sell or do anything. If you have any questions, please give us a call. This is just for our client updates and to keep them informed. So other than that, have a great weekend. I wish you well. And again, please feel to give us a call or an email.